Hello everyone, today is Friday, June 18th, 2021. My name is Evan. Welcome back to our weekly stock market analysis video. If this is your first time tuning in to one of our videos or this channel in general, thanks for joining us. Thanks for tuning in. Here's how our weekly market analysis works. We break this video up into two parts. In part one, we look at everything that went on this week in markets. We take a fairly macro approach. We look at things like correlations and volatility, term structure, credit markets, interest rates, all the good stuff, and pick apart everything that stands out and looks interesting. And there was a lot that stood out and looked interesting from this week of trading. So you're definitely going to want to stay tuned for this week's video. In part two, we jump into the charts. We look at those longer term trends. We put everything from part one into context and then try and best position ourselves looking ahead. So hopefully that sounds good to you. There's lots to talk about. So let's dive right in here to some of the big takeaways and some of the big movement that went on this week in markets. Now, it really sort of stemmed from the FOMC meeting we had on the books earlier in the week on Wednesday. We had the Fed come out and basically raise their inflation expectations. And what that essentially did is kicked off a chain of events. The most important was the short end of the yield curve really spiking to a very accelerated, faster, higher level, right? We saw a short-term spike in short-term interest rates. And what that does is it causes this ripple effect, mostly then by the US dollar, which then sort of reacts and resets in relation to these new rates. And the dollar ends up ripping to the upside. And then the dollar ripping to the upside then sets off more chain of event actions, which bleed into equity markets. Financial stocks are getting hit, commodities are getting hit and moving in relation to it. So we had this bit of a chain reaction reset this week, and lots of areas of the market really saw some outsized movement. Interest rates, credit markets, the dollar, commodities, financials, energy, all of these were really moving this week. The only thing that sort of stood alone and the same, and it is probably what the majority of all of us trade here, is technology and growth NASDAQ stocks. So if we look here at the equity market performance this week, look at this right-hand column here. One of these looks a little different than everything else, and it is the NASDAQ 100, which basically went through this week entirely unfazed and in fact up a little bit on the week. Meanwhile, we have the Dow Jones down 3.5%, the Russell down over 4%. So depending on where you were this week, you felt this week in a much different way. You're either sort of enjoying the weekend here, not thinking much happened, or you're looking back at this week saying, wow, that was a bit of a rough ride based on how things have been. So that's why we've got lots to talk about. Let's continue on here and take a look at our usual sort of sequence. We're going to start with market internals, and you can see market internals were strong on the week, but notice these numbers are basically drying up a little bit as the week went on. So if you look at the first row here, this is the NYSE number of stocks hitting 52-week highs minus lows. So we were up 260 on Monday, fell to 169 Tuesday, 163 Wednesday, 117. This number's probably not as low. I had to pull this number because I record these videos right after the close. They're sort of unsettled values, so I don't have the pure sort of final number here. So it might be higher than this, but I think the trend is going to continue that we slowly sort of weaken throughout this week, and that's something we're definitely going to want to pay attention to. If you look at the second row here, this is the cumulative sort of AD line on the day, and you can see every single day here was negative, which basically says that every single day this week we saw net number of stocks declining on the session. Furthermore, if you look at the third row, here's the percentage of stocks over 20 SMA in the S&P 500. That's down to 24% now, which is one of the lowest readings we've seen in a very long time. So all of this is to say that we are seeing the weakening underneath the hood right now as market breadth sort of deteriorates. I want to be a little bit cautious because, you know, when we look at this chart here, this still shows that there is an uptrend that is still very much in place here in terms of stocks hitting 52-week highs. We're starting to flatline just a little bit right now. We're going to want to see what the final numbers come in on Friday look like, and then how we react going into next week. But this is something I'll definitely be paying close attention to next week to see if we start to flatline and roll over. That would be a very negative sign here in my eyes for the market. Now, if we look at sector performance, this basically kind of reiterates here that the breadth was pretty lousy this week. We, in fact, only had one sector that was green, and again, it was technology, and it was basically barely green. It was essentially flat, up 0.03%. Everything else was negative here. So we had tech, consumer discretionary, and healthcare in the top three. And on the downside, we had materials, we had financials, and we had energy, which were all down 5 to 6%. So some very large down moves there in each of those sectors. If we look at correlations, here's a couple of things that I think really kind of illustrate what was going on this week and kind of the new, correlations and trends to sort of pay attention to. So if we look at the dollar, so that is this UUP symbol here, that's our proxy for the dollar, you can see that we have a almost perfect inverse correlation to what the dollar's doing and what the Dow Jones is doing. So basically what that's telling you there is that as the dollar saw its largest move to the upside in over a year, we had the Dow Jones seeing one of its largest down weeks in about a year's time as well. We're seeing that move in lockstep. The same goes for the S&P 500, not quite as tight of a correlation, and the same thing goes for the Russell 2000. Notice, though, the NASDAQ is totally avoiding this, right? The NASDAQ is not caring about what the dollar is doing. But if we go down just a couple of lines here, take a look at this percent TNX. This is the 10-year yield, and look at the minus 0.5 correlation with the NASDAQ. So what this is basically illustrating here, and negative 0.5 is not a super strong inverse correlation, but it's notable. And what this is basically telling us is the same thing we almost always talk about, is that it's really the yields that drive the NASDAQ performance, right? As yields spike, right? As we saw, essentially, think back 3 months ago as TLT was getting crushed, right? As the IEF, as the 10-year yield was rising, bond prices were falling, the NASDAQ was getting crushed, and it was this rotation into energy, financials, industrials, and Dow Jones stocks. Well, now the exact opposite is happening this week. We're getting, in fact, the TLT rallying and seeing one of its biggest moves to the upside, and that is allowing the NDX, the NASDAQ, to outperform like it did on this week. So all of these sort of markets are connected, right? They're correlated, and this is why we go to such lengths to look at all of these other views. Price is interesting, price is truth, and price is something we all need to pay attention to, but we can gain better insights if we look at things like correlation, volatility, market internals, and all of the things that we talk about here on a week-to-week basis. So those are definitely the two notable standouts there that I want to talk about, is the dollar and then some of that TLT performance. And if we look at volatility this week, we essentially saw two things happen. It was a very interesting week. I mean, everything has its place here on what's notable. The blue line is this week's VIX term structure, and the orange line is last week's VIX term structure. So basically, we saw essentially volatility rise across the whole term structure. So essentially, there's more fear in the market, if we want to just say it like that. And what's also noticeable, though, is that the front month contract here, so the VIX, as we all look at it, so the 19.47 value of the current VIX value, has risen quite a bit relative to the 3 month. So the steepness that we've been seeing in the market is starting to kind of come back down to really just more levels. But what we do need to be careful of is if we do continue to see this VIX spike and then we move into something that looks, like an upside down, it starts high and then it goes down, then you're in a term structure of backwardation, and that is where things can can get very loose, aggressive, and worrisome for equity markets. We're not there. I'm not implying that we're going to go there, but this is again why we look at things on a week-to-week basis, so we can at least be prepared and keep an open mind on the possible scenarios. Interest rates and credit markets. So this is where all the fun was. In fact, really, I should have included the 1 year or the short term, kind of even lower than the 5-year yield in this table. Maybe I'll add it in here because I only have the 5-year yield, but basically look at the 5-year spiking 18%, right? And so we even actually saw more movement in the shorter term duration. And then if you look out here, in the 10 and the 30 year, you're getting the exact opposite happening. And because that simply is, or is a simplification of that explanation, is because the Fed does not control the long end of the curve, right? They only have their finger on the short term, their overnight lending rates and everything, 1 year or less. So they don't really dictate what happens on the long end, but, it certainly all influences in one way or the other. But that goes to show the sort of disparity we saw this week. And if we look at investment grade bonds and high yield bonds, I think this is actually kind of interesting and notable and somewhat encouraging, is the fact that we're not seeing any big dislocation or warning sign here in terms of the credit markets per se. We're still seeing, we saw down J&K weekly performance, but nothing that screams to, pay attention to, or something that's, grossly out of line at this time. If we look at dollar and commodities, again, here we saw a huge move for the dollar index. It was up 1.89%. And we saw basically all of the commodities getting hit in lockstep with that. So gold was down 6%, silver was down 7%. Those are huge moves for those particular commodities. We saw Bitcoin down 9%, which, on a relative basis, I guess, isn't that absurd of a move. It is a higher volatility asset. Agriculture, so the ETF DBA here was down almost 6%. Natural gas was down 2%. Look at crude oil, though, is still sort of championing the leadership here on commodities. It is still the strongest of the bunch here, and that crude oil trade is continuing to just work and power itself higher. So the report card on the week, even though there was lots of movement, we still had 2 saving graces. We had market breadth, which is on the decline. So the second derivative, right? The rate of change is going down. So we do need to be careful, but it is still supporting this market right now. So let's keep that in the check mark. And credit markets aren't falling apart yet. They're still holding things together. So all in all this week, give it a C in terms of performance, but we're definitely going to keep a close eye on a lot of these things that we talked about.
Feel vindicated. The Fed actually at least somewhat caught up with you, I think, this week in saying we do, after all, have to be concerned about inflation, transitory or otherwise. So are you feeling good today?
David, look, I think the Fed signaled that it recognized that we were in a different place than it had expected on inflation. The best measure of that is if you look at what the market is now saying about real interest rates over the next few years. You saw an unprecedented, or nearly not unprecedented, but very large 5 standard deviation move in the market's expectation around real interest rates because of what the Fed signaled, principally with the dot plot. You saw that happening without the Fed changing in a major way its forecast of economic growth or its forecast of medium-term inflation, simply marking to reality its near-term inflation forecast. So I think you did see on Wednesday, a signal that the Fed had changed its reaction function in a significant way. I think that was an appropriate change given the inflation reality. There was a lot of volatility under the surface in markets, so I think they're still processing what happened, and you shouldn't try to read every detail as fitting together in a pattern. But I think yesterday will be remembered much, much more than most FOMC meetings as the beginning of the Fed's recognition that overheating is the issue that it has to deal with going forward. And given that overheating has been a major concern of mine, I'm glad to see that they have that recognition. But look, at a certain point, Churchill talked about it not being the end, it not being the beginning of the end, but maybe it being the end of the beginning. And I think with respect to recognizing that the economy's now in a very, very different kind of place where demand pressures are a crucial issue, I think that's exactly what we have seen here. And I was glad to see in particular the change in the dot plot, which showed that the basic implausibility in a labor short economy of rates being at zero out to 2024 is something that now a majority of the members of the FOMC recognize.
Yeah, so Larry, they get the issue now. I think it's fair to say. They've said 13 of the 18 members think the risk on inflation is the upside. So they get the issue. But are they doing anything about that issue? Because they moved some dots on their plot, to be sure, but they didn't actually cut back on their bond purchase, $120 billion a month. As you pointed out, that's increasing the accommodation, much less touch the rates. And by the way, if anything, it's a little surprising. The rate on the 10-year remained in the 1.5 range, and the equity markets, they sold off some, but it wasn't that dramatic. So are they doing anything about the fundamental underlying causes of this overheating, as you describe it?
I think we're going to have to wait and judge that. An optimistic view would be that because they signaled that they were on the case, that was reassuring to everybody that the accident that people feared was less likely to happen. And that's why equities were relatively tranquil. That's why the 10-year came down. After all, part of what the 10-year was pricing in was the risks I had been fearing, significant increase in inflation or the need for a major tightening at some point. So I think an optimistic view of those developments would be that, in fact, by changing expectations and changing their signals, that is policy in the monetary sphere, and they were rewarded for it.
Larry, I certainly take your point about the danger of over-interpreting the markets and what they're telling us, but address one thing in particular, and that is the flattening of the yield curve, because one of the things that happened this week was a pretty dramatic flattening of the yield curve. So the short end came up because the Fed certainly could drive that quite immediately. At the same time, the long end didn't. If anything came down, does that reflect the fact that the markets might think that maybe they are getting their arms around inflation?
It reflects two things, and in just what proportions is hard to know. I think it reflects certainly an expectation that they may be getting their arms around inflation. But, you know, inflation expectations moved hugely between the beginning of the day yesterday and the end of the day yesterday. They moved way down at the beginning of the day. That would have been very much like what you said. But by the end of the day, they had moved back up by 10 basis points. That's why I'm resisting an overinterpretation of those data. It may also be that if you thought that we were going to need to have some kind of big collision between monetary policy and the economy, those kinds of collisions send long rates way up. And we probably have taken out a bit of the risk of that kind of collision. So, and we've made the world probably a safer place and taken risk premiums out. So I think all of those things are contributors to the flattening of the curve. But David, I've learned in this that it's easy to form a beautiful theory around a market pattern and then have that pattern dissipate on you 2 days later. And so I think the more detailed the pattern one's commenting on, the less confident one should be in prescribing a detailed theory.
Yeah, fair enough. A point really well taken. Larry, you've always been very careful in saying you're not going to advise the Fed on what it should do. So I won't ask you to advise it what it should do from here on out, but I'm going to ask you, based on what you know, given the fact it now recognizes the issue in inflation and where it is, what you expect over the next few months, because people are talking about when they might announce the tapering, when it might actually take effect, how long it would take, when we'll really get some rate increases.
Look, my guess is that inflation is obviously going to have a transient element. It's been running at 8%. Nobody thinks it's going to stay at 8%. The question is whether the transient element is 4% or whether the transient element is 6%. And so how far down it's going to come. And I think the transient element's a little smaller than many other people do. I think the Fed's watching the data very, very closely. You saw that in this statement. And so my guess is that the adjustments are going to come on the sooner side of the distribution of expectations rather than on the latter side of expectations. And if the data come in as I expect they will, that will certainly be an appropriate set of changes.
Larry, going back in time, you warned about the danger of overheating literally the day that President Biden announced his American Rescue Plan, about the massive fiscal infusion that he was asking for. So you got that issue early, and it appears that other people now are catching up. I'm going to push you now and say, what's the one we're missing? What's the next one around the corner that we may not be paying enough attention to?
I think we need to be careful what we do with our trade policies and our regulatory policies, and we need to make sure that we make the huge corrections that are necessary to Trump-era policy on taxes and regulation and microeconomics. We need to raise the minimum wage. We need to be more supportive of unions than we have been. We need to do more on the green side. We need to raise corporate taxes. But I think we need to be careful to maintain a positive climate for business going forward.